Instead of the short-term fix and flip, these are loans for holding, for cash flow, for appreciation, for 30-year fixed rate mortgages. So we really view it as a separate investor and a separate product, but a very complementary product because we've seen a lot of people in the fix and flip space.
You found the Real Estate Law Podcast because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. If you're a real estate professional or looking to build real estate expertise, then welcome to the conversation and discover more at realestatelawpodcast.com.
Hello. It's another episode of the Real Estate Law Podcast. Thank you very much for listening once again. We have a great discussion that you're about to listen to. We'll get into it in just a second. I'm really excited about this topic. By the way, I'm Jason Muth, one of your hosts, Rory Gill, attorney from Urban Village Legal, Next Home Titletown Real Estate in Boston. Rory, we've been talking a lot about this, both online and offline, and that is financing real estate deals. So I'm excited to hear a little bit about some of the alternative ways to finance them, because I think that most people are just used to going to the bank down the street and saying, I need a mortgage. And that's not always the case for real estate investors, is it, Rory?
No, and we're covering kind of a mental shift that a lot of serious investors have to make when they go away from sort of the conventional debt-to-income loans that you'd get at your neighborhood bank to really looking at loan products that are meant for investors, whether you're flipping a property, whether you're scaling to have numerous rental properties or doing short-term things that are kind of outside the box for a lot of the conventional mortgage brokers. These are things that you should be aware of, particularly if you're looking to grow your real estate portfolio.
Yeah, and we haven't discussed this all this much on this podcast. I mean, we always talk about real estate meetups and people meeting each other, doing deals together. But, the big question that looms over everyone's head is, how do you get the deals done? Right? Like, how do you finance these things? So we'd like to welcome our guest, Robin Simon. And Robin is a partner with Easy Street Capital. And Robin, welcome to the Real Estate Law Podcast.
Thanks for having me.
Yeah. We're excited to hear a little bit about Easy Street Capital, kind of your story, how you helped found this company, what type of investors you're working with these days, some trends that you've seen. It's been a very volatile year so far. We certainly don't expect that to quiet up, good or bad, in the coming months. Just because, there's rumors out there about increasing rates from the Fed as well. We saw this year how some of those increases didn't necessarily lead to an increase in mortgage rates. So those things weren't fully correlated as a lot of people thought they were going to be. But, you're working with investors who are looking to purchase property and rehab, do a fix and flip loan. You're working with short-term rental operators, people that are really looking to scale their Airbnbs up. How did you get into this space? And, that's probably a great place to start.
A little history on Easy Street Capital. We are a private lender. We're located in Austin, Texas, but we have a national platform. So we'll do mortgage loans all over the country, really everywhere except North and South Dakota, just due to some licensing issues. So Easy Street Capital was actually founded back in 2015. The original partners of the firm had done a lot of fix and flips themselves, buying a lot of closure properties that need work in Southern California. They did that the early part of last decade, and then around 2015, 2016, they decided, hey, we're going to move to Austin. That's probably one of Texas is one of the next big growth markets. And instead of being on the principal side, the equity side, they're going to go on the lender side, just a little less risk. And then, of course, with experience doing thousands of these flips, of these purchases and rehabs, if anything goes wrong, we need to foreclose. They know exactly what to do. So that business has been growing steadily and chugging along for the last 7 years or so. We recently expanded back to California, throughout the Southeast, and now a national footprint there. And they're, having a lot of success, big volume, a great reputation online, which is really important in the hard money space. There's some, good guys out there, some bad guys, some shady reputations. So we really pride ourselves on a really good track record, serving a lot of borrowers, a lot of investors, repeat business and over the last few years. I actually came into Easy Street as a partner in last December 2021, to launch really a complementary, division of Easy Street, which is, long-term loans. So instead of the short-term fix and flip, these are loans for holding, for cash flow, for appreciation, for, 30-year fixed rate. So we really view it as, a separate investor and a separate product, but a very complementary product, because we've seen a lot of people in the fix and flip space, and they're saying, well, instead of flipping, I can make more money holding this into my portfolio and doing the BRRRR strategy and refinancing it instead of selling it once the property is done. So we had a lot of internal referrals, internal borrowers who we've done lots of rehab loans with over the last few years. And we were losing those to competitors because we didn't have a long-term refi product. So that's where I came in. It's called the EasyRent program. And now we offer those investors a one-stop shop, buying property, getting a hard money loan, and then refining it into a 30-year loan, once that's rehabbed. And we're seeing a lot there, especially today, where the market is a little choppy, and you go in, you buy a property, fix it up, you expect to sell it for an ARV, and maybe the market's not there, but if you kept it and rented it out, you're seeing cash flow every month. So instead of having to go to a lender, instead of having to go to a new shop, you can just pivot, stay in house, we're comfortable with you, do the refi with us, and add to your portfolio. Other part, that's not all we do. We also have kind of a full suite of what's called DSCR loans, which are mortgage loans that don't look at DTI. They don't look at personal income. They're really based on an easy qualification and the cash flow of the property. So that's anything from a rental property, a single family home, duplex, triplex, up to 8 units. And then we also specialize a lot in short-term rentals. So Airbnb properties, just vacation rental properties. We'll give you that 30-year fixed rate loan, that easy financing, that easy qualification, and then we'll be able to underwrite that not on your personal income, not on your ability to manage multiple vacation homes, but we'll actually look at what that property can do as a short-term rental and how much it can earn.
Yeah.
I've been running that piece, getting it up and running in 2022. It's been a little bit of a choppy market, but we're still growing and, making a lot of investors happy, and still, have a pretty positive outlook for growth. I've done that at this type of platform at another lender previously, and then in kind of just a brief background of my career before that, it was mostly commercial real estate, but I've kind of switched into this gray area between residential and commercial lending, where it's residential properties, but they're commercial loans because they're income producing properties only. We really love it, and I'm really, really excited about, the future of this industry, especially in the short-term rental space.
Yeah. Sounds like you've assembled, a great deal of different loan products and everything that are geared toward the investor market. And I kind of want to just unpack a little bit about what you said, particularly for people who may not be as familiar with this space. So in the opening, I started to contrast you a little bit to a conventional mortgage broker that relies on DTI, debt to income, kind of the traditional way that we think of home buying process, where you take your income and then, a certain percentage of that can be allocated toward the cost of housing. And that's how most DTI or conventional mortgage brokers operate. That's the critical factor that they look at there. When should somebody be giving you a call instead of the mortgage broker that they may have used to purchase their home?
That's a great question. It's something we see every day. So really the DSCR rates, my mortgage loan rates, they'll all be the same kind of program, 30-year fixed rate, pretty basic loan. Our rates are going to be about 75 bips to 100, so 1% higher, in terms of your interest rate versus a conventional product where you're getting a DTI product, a conventional bank or agency lender. So if their rates are at 5.5%, our rates are probably 6.5%, depending on other factors. I tell people kind of flat out, hey, if it's your first, second, third property, you're still qualifying, you make W-2 income, and you can qualify and you don't mind the paperwork, you should go that conventional route, because those are, terms and rates we really don't compete with. We're really, really, really good for when you kind of graduate and want to scale. And it's that 5 to 50 really units you have. When you got your first couple properties, you realize you're doing it, you want to make that proverbial jump into scaling. Maybe you want to quit your job. Maybe you're ready to do the real estate investing full time. There's some other reasons, because it gets hard to qualify, once you get 3, 4, 5 properties, especially, that DTI calculation. Other advantages we have is we'll lend to LLCs. We'll lend to you in your individual name or LLC, really. Some states have some rules around it, but we prefer an LLC. So it really goes into that scaling question where, okay, you have maybe your own home and 1 or 2 extra rental properties. That's okay to put these loans in your name to get the best rates. But once you get, 4 or 5 and you have properties in different markets or all over town, it really ends up being, smart in a lot of cases to restructure this into an LLC and give you the protections. You guys probably are, know more than me about the benefits of that. That's another reason, when you want to switch over to the DSCR product, my product, rather than, the conventional. Other advantages are we offer partners and with the LLC, you can have 2 or 3, partners on a loan. So, a lot of people like to, not do this real estate investing journey necessarily on their own. They might want to bring in, 50-50 partners or a few partners to run this business. So our loans are fine with that. Conventional bank loan, might be hard there. And then, banks, agency, Freddie Mac, Fannie Mae, they generally also even have limits. So a little vague because, every year they have a cap on investment properties. Generally, it's about around 7 loans you can do, with an agency until you're capped out. Size on conventional, is, a cap sometime. I think this year it's around 620,000. So when you want to go bigger, when you want to go with a partner, when you want to go with an LLC, when you're ready to scale past the concentration limits, those are all the big reasons why people will make the jump into the, private lender space. And then there's flexibility as well too. So maybe you qualify for conventional, but you're really going into short-term rentals. And a bank or conventional loan is not going to be able to use, say, Airbnb projections or, use your operating history or really look at it in a more creative way where private lenders like us can really be ahead of the curve there and be a little more creative, flexible on, underwriting guidelines as well. So once you've scaled up to like 50, 60 properties, then you're probably looking at big institutional money. So we are really right there in the middle, probably, I would say overall, 5 to 50 when you're ready to make that jump and you're ready to scale, we're a really good option.
I just want to make sure that we're, not skipping over something that some people want to understand because, when we're talking about, kind of in the bottom of the scale, we have the conventional lenders that will rely on DTI debt to income. But as you suggested, most people will run out of capacity at around 4 properties or so where the debt to income analysis doesn't make sense for them anymore. And just the complexity of the loan application is starting to get to the point where it just isn't feasible. So you sacrifice maybe up to a point in percentage interest to go to a DSCR loan, debt service coverage ratio. But before we get too far in the conversation, could you explain what that means, the debt service coverage ratio?
Instead of looking debt to income, instead of looking at your personal income, we'll look at the income, the rent basically that will be generated by the property. So I didn't mention before, not everyone has a W-2, so there's another reason to use a DSCR loan because say you're self-employed or whatever, where it comes to your salary, it's not a W-2 with multiple years of history. But DSCR, it stands for debt service coverage ratio, and it's basically a ratio of the revenue and the money coming in rents divided by your expenses operating the property. So for us as a lender, it's a pretty simplified ratio. We only take into account on the expense side, the debt service, so your monthly principal and interest payment, and then property taxes and insurance. So we don't take into account, any sort of management fee or utilities or repairs and maintenance where you might do that when you're underwriting a loan personally, but for us as a lender, we'll qualify you based on, just those 4 costs. So, for an example, if you're making, let's just say you're making $120,000 a year in rent on a property. And when you add up your debt service for the year and your taxes and your insurance, and that's $100,000, then you calculate your DSCR by 120,000 divided by 100,000. So that's a 1.2x DSCR. So that means for every dollar of costs, you're making $1.20. So a DSCR of 1.00 basically means you're breaking even. All your rent goes to all your expenses, and you're right on zero profit but zero loss. So we calculate that DSCR number to see how much comfort, how much cushion are you bringing enough money in rent and income to cover your obligations, owning and operating.
If we take that kind of borrower, somebody who's looking to purchase the long-term rental property to start with, and so the key thing there is that they're identifying a property where they can demonstrate that the rents are going to exceed the costs. Is there anything else aside from just picking a good property that a borrower should do to get themselves ready for a long-term DSCR loan?
Yeah, I mean, it really is driven a lot by, that property and that property's ability to generate cash flow over the long term, not only in the next, year, but long term, since we're writing these loans as 30-year fixed. When it comes to your pricing, so what kind of rate you're going to see, what kind of closing fee you're going to see, it can vary quite a bit. The three main factors are going to be your DSCR, your LTV, so your leverage, so how much money you're putting down versus your loan, and your FICO score. So if you're looking to really get the best rates, the best terms, you want to make sure that you are keep that FICO very high, because that will make a big difference. Choose a property that is cash flowing, as much as possible, and be as conservative on leverage as possible. So we'll go up to an 80% LTV, so where you only have to put 20% down. We'll even, in some cases, finance properties with the debt service coverage ratio is under 1, where it's negatively cash flowing, and we'll go down to pretty low FICO scores. I think right now we'll go down to even 620, but you're going to pay very, very higher rates and fees to get that done. So those are really the three levers that you want to maximize as much as possible if you're looking for the best rates and terms.
Why would you do a negative? Why would you go below 1 for that ratio?
That's a really good question, and a lot of lenders will have different answers and say we don't want to go under 1, but I'm actually a bit of a contrarian there. I think we see deals that are good that are under 1. Some of these situations are, so we underwrite pretty conservatively in terms of it's a long-term rental. The appraisal is going to give you what's called a Form 1007, and that's the long-term market rent that the property will earn. And then we'll compare that to the in-place lease if you have it leased out. And then to be conservative, and I'm pretty much this is pretty industry standard, is we'll use the lower of those in-place versus market rent to underwrite. So say you're buying property that has a tenant in there that's paying $2,000 a month, but the market rent is $3,000 a month. And you buy the property, the lease is going to roll in 6 months. So you buy it, you identified it under market lease, you're going to raise the rents to market, common real estate investor strategy in 6 months when it rolls, and that's going to be your strategy. You're willing to, live with a lower lease amount for the first 6 months because it's a long-term investment. So us as a lender are going to have to underwrite the DSCR with that 2,000 versus that 3,000. So on paper, that could be a sub 1 DSCR, whereas in 6 months, we fully expect the property to be leased at market, and then that will kick it over the 1 DSCR as well. These are also 30-year fixed rate loans. Took a look at it, and that rents have really skyrocketed the last couple of years, and there's not a lot of evidence saying they're going to go But generally rents exceed, the rent growth has been about 8%, I think, on average in the last, 40 years. And generally rent growth exceeds growth in property taxes and insurance, et cetera. So maybe you're losing money on year one, but you have a fixed monthly payment for 30 years. And maybe after year 3, after year 4, the rent keeps growing. So what was initially a sub 1 DSCR negative cash flow at the beginning of the loan becomes a positive cash flow for 27 years after of when you locked in a fixed monthly payment.
Yeah.
And there's also, there's markets where, very, very high-end popular markets. We're here in Austin where, it's really basically impossible to get a property cash flow. California for many years, where, there's been a lot of skeptics saying, why would you buy a negative cash flowing investment property and bank on appreciation? As, potentially a very risky move, but then there's a lot of very wealthy people who bought properties in those markets, California and in Austin and, New York that, are laughing all the way to the bank with just gigantic, property appreciation that far outpaces maybe losing a little bit of money. So those are some of the reasons I give. There's also, lots of tax benefits that come with real estate. So maybe, you have a portfolio of cash flowing properties and then you can absorb some tax losses on some properties that are breaking even or maybe losing a little bit. And that gives you a holistic benefit. And then there are short-term rental, properties where maybe you don't have the experience, you don't have the, history, 12 months history showing a robust cash flow. Maybe you're confident that you'll make a lot of money as short-term rental, but as a lender, you underwrite, conservatively in some cases and underwrite and say, okay, this property will make $2,000 a month as a long-term rental. It'll make $5,000 a month as a short-term rental. We're going to underwrite on paper the $2,000 per month, to be conservative, showing a negative DSCR. But in reality, if you operate as a short-term rental and you know what you're doing, you're going to easily cash flow the property. So again, a few situations where it might just be on paper for conservative underwriting the negative DSCR, when in reality, it's going to be a cash flow property.
Yeah. I know you've been in this space for a long time. I think that the conversation we're having right now would have been foreign to me about 16 months ago, before we did our first deal using, a private loan similar to this for one of our short-term rentals. And, just to kind of humanize this a little bit, because if you're listening to this, you're saying, okay, I think I get some of that. Some of it might be confusing. I'll talk about our situation. I'll talk about how we kind of have run down the road where we're investigating, Easy Street Capital and, financing opportunities such as DSCR loans, everything you've just mentioned, Robin, a loan in our primary house, right? And, we've moved a couple times. So we've bought, different loans over the years, buy one place, sell one place, but the short-term rentals that we operate, 2 of them are on second home loans. Vacation home loans. They're in 2 different markets, so we're able to do that. And we took ownership of them, intending for them to be second homes that we would supplement. And sometimes it tilts a little bit more toward the short-term rentals, but they're both conventional financing, longer, standard longer-term loans. I think one of them is a 30-year fixed, one of them is a 20-year that I refinanced. The rates are rock bottom. It starts with a 3. Going to be really difficult to want to refinance those, and they have a ton of equity in them. That's how we were able to do those. It was all from, when I was a W-2 employee, we're looking at debt to income. I was working with, conventional finance companies, tons and tons of paperwork, and the paperwork got even deeper the more properties that we got. And it became very, very complicated. This most recent loan that we did for our current primary home was nothing like I'd ever seen before. It was just the amount of things we had to submit, not to complicate things more, but we have a construction loan on another property that we're doing with another bank, which is, I think, going to be the steal of the century. I locked that in at 3% for 30-year fixed in November. for a property that we're building right now, which, God, I don't know when I'm ever going to refinance that thing. But, that was another conventional loan that we're doing with a great local lender. And, we have an LLC, where we operate a commercial condo, and that is done with a commercial loan with a local commercial company in Boston. But Rory, the first kind of foray that we have into this space was last year with the most recent short-term rental property that we posted, right?
Yeah, and it was because we started to hit these limitations in the conventional market with, operating another property in the same market, combined with the fact that this one really truly was an investment property. It didn't have a second home purpose. And then the DTR, the debt to income, or the DTI, the debt to income ratio just started to become unfeasible for us. So we managed to do it this way. And, while the rate was higher at the time than we would have experienced otherwise, it was a necessary step. And, I'm encouraged to do that again in the future and to keep building the portfolio that way, just because it would be completely untenable for us to keep pursuing these conventional loans. We did it. We had the experience. We had to demonstrate that we were credit worthy. We had to have decent enough FICO scores, but I don't even think they looked at the tax return as part of the application process.
Definitely a different path. And we took that path because this property, for a few reasons, this one's definitely in an LLC and we're operating it, primarily as a short-term rental. We're not even allowed to really occupy it. I mean, we do, to maintain it and everything, but we had to sign something saying we're not going to live there, right?
Yep. So it's almost the opposite. When you have a closing for your primary residence or second home, you're signing affidavits that you intend to use this as your primary residence, or the intended use of this as a second home. We had to sign kind of the reverse affidavit saying that we are not going to occupy the property, that this is for a rental purpose. And so, so we have to abide by. Of course, we can go in there, we can stay there to maintain the property. We had to go there and stay there to fix the property up and get it ready. But we couldn't just decide to up and move there.
Right. Rory, one more kind of legal question right there, and then I'm going to ask Robin something. If we're going back to the vacation homes, like let's say that you're listening to this saying you own your home, you have some equity there, you've saved some money up, you want to buy a vacation home, but you also want to short-term rent it out. What's your recommendation about going to a local lender in terms of disclosures? Right? Like you don't want to lie. You don't want to sign anything that, they could call the loan. But, what is that conversation like in your opinion?
You do want to be upfront with two people, the mortgage lender and the insurance company, about what your intended use are, because they can work with you if you start that conversation upfront. And while lenders really cracking down on it is relatively rare, you really don't want that to happen. And we're in an environment where rates are rising, or at least they're volatile. And you don't want a lender to be incentivized to go in and call a loan because they found that you were dishonest in the application process. So, with the second home, there are a certain amount of rentals that are allowable. The attitude of the lender might vary lender to lender, but you do want to be kind of upfront with them with your intentions and your intended uses for the properties, because you don't want to make it a business habit to start signing affidavits that are not true.
Right. Robin, so, you have a lot of long-term clients, I'm sure, that, they call you up, they have a mortgage, a member of your team. You guys are already talking the same language in an advanced capacity, right? What are those conversations like with the people calling you for the first time, or the people that are like us that for a year ago said, I don't know, let's explore this. This might be a way that we could actually jump in and get some more financing for some more properties as we continue to scale. I'm guessing you're getting a lot of those phone calls these days. As short-term rentals are getting more popular, as a way to, increase the cash flow of a property, and people are probably bumping up against those income limits with their conventional financing.
I might not have the fullest answer to that. We have a great team of originators, basically we'll call our sales team, who specialize in taking those calls and walking through, potential new borrowers and really explaining how everything works. But kind of overall, our big pitch, and our, value proposition is the ease of this and, easiness. We're named Easy Street Capital, whereas it should be a pretty simplified, straightforward process, versus what they're used to. So I know you mentioned before, the amount of paperwork, the amount of headaches just even on a primary home loan, it gets very high. And, there's good lenders, there's bad lenders out there. Sometimes they can process it, very quickly. Sometimes they're asking you for the same document over and over again. Sometimes, it's just stretching months because they keep finding different things to ask for. So we'll always ask the questions, but it really comes back to, how easy it is, compared to, conventional DTI financing or dealing with a bank. So, we stress there's no tax returns. So that's big for a lot of people. No income verification. So you don't have to look either. We ask for 2 months of bank statements. So just 2 statements, to show basically you have 3 to 6 months of payments in the bank. And that's really it. We don't ask for 2 years of bank statements or all this, that, and other thing. And we have an application, that's, a PDF, that's a few pages, that's 10 or 15 minutes to fill out. And, we can get you a full term sheet and terms within a couple hours. So it's a very, simplified process. We kind of lay it all out that we need on our application, and it's not a lot of documentation. We'll really emphasize that and be glad to talk people through things, but there's just, compared to what people might be used to, conventional wise or bank wise, the conversations are really about what's not needed versus, what we might need.
Yeah. What about people who, they're surprised by some of the additional costs and fees? Cause these are higher rate loans. Do you guys use a 5-year period that you can't refinance it, or there's a penalty for 5 years, or does that not apply for your loans?
Our standard is a 5% prepayment penalty, but we can be flexible there. We can reduce that or get rid of it entirely. It's just going to, be exchanged with a higher upfront fee or rate.
Yeah. And then some of the closing fees might be a little bit higher for loans like this. Like, are there points involved with your loans? I've seen some other, some other private lenders that are, charging 1 or 2 points based on the rates.
We'll charge some closing points. So we like to be very transparent. There's a lot of, especially in the hard money space, and a lot of lenders out there. It's a low barrier to entry industry. So a lot of people come and go. And a lot of those people that are coming and going, sometimes they'll be a little unethical or juice the fees a little bit. So we really pride ourselves on being fully transparent. We have a hurdle to make, X amount of money on a loan, but, that can come in, a balance between, interest rates and, the points that we charge. So, we can be flexible on that kind of seesaw to the point where, we can charge 0 points, but you're paying a little higher rate, or you want to buy down that rate and pay the lowest rate possible, but you're willing to pay, a couple points, 2 or 3 points up front, and kind of anything in between. We also have a little unique, I think, in lenders is we have a deposit that's up front. It's purely what we call pass-through fees. So we collect fees that, basically we pay out to third-party vendors, and then we'll refund the difference and not make any money on that, at close. So we'll lay all that out in our term sheets. These are pure pass-through. We'll show you how much we spent on the appraisal review, legal document generation, lawyer review of the entity documents if they're going through an LLC, the flood certificate, the credit report, the onboarding fee to a servicer. So we definitely pride ourselves on being very transparent on the fees, and it's usually pretty reasonable.
Some of the things you just mentioned right there, those terms are probably very familiar to people that have purchased their primary home or that first investment property. Rory, in terms of closing loans like this, what is the process like afterward? I mean, you close a lot of loans as an attorney here in Massachusetts, being that you have to have an attorney closing. Are you seeing like the paperwork that Robin's just described or the process right there? Is that going to feel similar to an investor when they sit down in your office and start signing papers?
It actually will. I mean, the actual kind of just the legal work changes when a property becomes like a 5-family or greater, or if it's a true commercial property, and, as one would conceive a commercial property, because then there's additional, due diligence in that case. But if you're purchasing a 4-unit or less residential building, it's going to feel very much just like a residential loan closing. It's going to happen the same way. You might have a couple extra steps related to the LLC and the entity, but it's going to feel very similar to the closing you have for your primary residence.
Let's move toward our final questions, and then we're going to have Robin say where we could find him. We'll put all this stuff in the show notes, your link to your website and all that interesting information, so you're easy to be found. But, one thing I want to emphasize is that this might sound very complicated if you haven't gone down this road before. So if you're listening to this podcast and you're still listening to this podcast because you're very interested in figuring out how can I get money for that deal, this is a way to do it, and there are companies like Easy Street Capital and Robin and his team that could actually help you walk through that process of finding financing for deals. Because one of the things that shouldn't hold investors back is, how do you find the money? Like, that was a question that we had many, many years ago, which was like, how am I going to find the money for this stuff? The money is out there for these deals. If you don't have the down payment money, go raise the down payment money. Go find investors that could help raise that down payment money. If you don't know where you're going to get the other 80% or 75%, it could be a conventional loan right down the street from you at the bank that you knock on the door, or it could be a guy like Robin and Easy Street Capital, because they have ways to finance investors. All those investors that you see at the real estate meetups, like, they're not sitting on millions of dollars of cash in the bank, and they're not using all those millions of dollars of cash to walk in with cash. Some of them are, right? Some of them are doing that. But, I think everything we've heard for many, many years is about leverage. Now, some people, Dave Ramsey's not going to like that, right? But like a lot of people, they leverage everything, right? You leverage it. And like, we've been fortunate that the market keeps going up, that it's a smart move to be leveraging that money, because that leverage is turning into more wealth. So, just wanted to put that all out there as well. It's a space that if you're not in this space, you have no idea what any of that conversation was all about. But like, if you are investigating real estate as a way to financial freedom and financial independence, it's companies like Easy Street Capital that can help get you there, not just your local bank down the street.
Jump in there really quick. I've been doing a bunch of trainings. We bring on a lot of people growing fast, and that's kind of the first lesson that we go over, is the power of leverage in real estate. And us as the lender, we get zero, participation in any appreciation of property, whereas the investor gets 100% of it. And it's a little bit of a trick question, but it really opens people's eyes when I say, hey, we have $1 million property and a $700,000 loan. That property appreciates to $1.2 million. How much, as the lender, do we see of that $200,000 growth? How much is the investor? And it's 100% the investor, because they're leveraging that property, and they're only putting $300,000 down, and they're seeing, the $200,000 appreciation 100% themselves, potentially buy multiple properties and see all that appreciation with leverage, versus if they can only, buy one and don't take on debt. They're still getting that appreciation, but they're leaving a lot on the table where it's very one-sided. That example tends to kind of open people's eyes to really the power of making a lot of wealth in real estate is been used by a lot of people to use leverage, because the investor is able to capture 100% of that property appreciation when it comes to real estate.
Yeah, excellent points. I mean, that very well could be your answer to the first question that we have for you for our final 3 questions, but maybe it's not. We'll get into these questions that we ask all of our guests just to get to know you a little bit better and wrap things up. First question we have of the final 3 is, if you can get on stage for a half hour and talk about any subject in the world with zero preparation, what would that be?
I know we touched on it a little bit in this podcast. I know you guys are familiar with it, but we didn't talk too much about it. It's the short-term rentals industry. And, I've been getting on stage at conferences and making, talking about short-term rental financing in the industry, a lot over the past year or two. And that's probably my answer to this question, just because it's very exciting industry to be a part in. We see these conferences that, are growing in, amount of attendees, amount of people involved. There was the short-term rental forum, which was the first of its kind this year by IMN in Austin a couple of months ago, that we were a heavy sponsor with. But you see a lot of people doing short-term rentals, making money, investing in real estate in that niche. But the most encouraging thing is there's cottage industries growing around that. So now there's 3 or 4 pricing software companies that exist solely to help people maximize their short-term rental earnings and algorithmically price the best possible way. There's short-term rental management companies. There's software for managing your accounting and your guests. There's amenities where you sell products for your short-term rentals, different types of smart locks, different types of XYZ. And it's really exciting to see, the durability of the growth there. Feels like one of the few industries and kind of one of those once in a lifetime or maybe a couple times in a lifetime, average everyday people, mom and pop investors, people that aren't institutions are able to kind of get in the ground floor and buy a bunch of Airbnbs and scale a short-term rental portfolio where maybe in 5 to 10 years, I'm thinking it's going to be institutional. It's going to be Wall Street. It's going to be a big time industry with big barriers to entry. But this is one of those times where you can really, really get in the ground floor and scale as a kind of a mom and pop, as a small time investor that can scale to being a big time investor. And it's really exciting. So I tend to think it's kind of it's not new anymore. It's been around a few years, but I think it's still somewhat in the third inning of the growth from Airbnb coming out, 12 years ago to an institutional asset class. And by being in the third inning, I think it's a huge opportunity for a lot of people. Very exciting.
That's an interesting way to put it, being in the third inning. And I think you're right. We've been in the space since 2016, right, Rory? That's when we got the first one.
We have, and it feels like it was 20 years ago in terms of this business, just because of how, the additional listings that are coming up around us and the improvements that we made to it. But there's some thoughts out there that the market's getting oversaturated. I don't know if that's the case just yet, but the market's certainly maturing.
Yeah. Robin, a lot of what you alluded to, pricing software, amenities, property management software, all that. Those are things we've also discovered relatively recently, in the past 12 months or so, some sooner, some before then. Before then, we were slugging it out. It was a lot of DIY. We built our own systems. We scaled up, the properties that we have. We thought we were doing pretty well enough that, when I had the opportunity to not work anymore, I said, this is what I want to do, and we're going to scale this up. And then I start peeling back, some of the layers of the onion, and I'm like, oh my God, we could be doing so much better. That's kind of how I see it. And you're right. The third inning is probably the best way to put this. We're a little nervous that, it's like, there is this secret cottage industry that suddenly everybody knows. But what are we going to do? It's not our job to keep the secret in the bag. It's way out of the bag right now. So it's, how do we profit from, being experienced operators in the space, and have that little bit of a head start? So that's what we're figuring out right now.
Yeah. And I totally agree with that. And when it comes to where I'm saying kind of third inning, it's not the beginning, it's beginning middle. There's still, it could be saturated because there's still the ability for a lot of people to get into the industry, to start, to, buy their own Airbnb and not have, economies of scale with the pricing software, with the management, team and with everything geared up. But I don't know how long that's going to last. I think there might be a year or two, or that's much harder than it was a year or two ago, and it will be much harder, in a year or two from now, for that. And I think the people, like yourself and like hopefully a lot of your listeners who have been doing it a couple of years, have peeled back the layers of that onion, have figured out, I was doing well, but it's a game changer with pricing software and a management, company and cleaners I can trust and XYZ. It's going to be harder and harder and harder, for people to break into the industry as it gets more institutionalized, where maybe 5 years, you're not going to be able to jump in. You're not going to be able to have success on Airbnb because people that have been doing it for 5 years, have everything dialed in, have all their pricing and all that, are going to eat your lunch. So, that's why it's really exciting, because there's still time, to enter this and to be an equity owner in an emerging institutional asset class. But it's becoming institutionalized, and there's going to be a whole ton of wealth built, I think, in the next few years. So it's not too late, but it's getting there.
Yeah. I think we're getting down the road also of, some of the investors like ourselves, taking a bunch of the properties that are profitable, packaging them all up. Maybe we'll sell all these to an investor, in a couple of years. Who knows? An investor might actually find properties to be worth more if they're also profitable Airbnbs instead of just like, what the empirical value of the property is. If you have that property that can be used, that someone can occupy, great. It's worth $500K, $600K, whatever it is. But like if you could also prove on paper this has been a successful short-term rental, maybe it's worth even more as a result. So that's how the future. Let's see what happens in the future as the real estate market just continues surprising all of us. Second of our final questions, tell us something that happened early in your life or career that impacts the way you're working today.
I'll go with the career aspect of it. I usually tell this story of kind of how I got into real estate. I went to business school at the University of Texas at Austin to do a one-year program and really an accounting boot camp to get a CPA and to really enter the workforce in a Big Four, public accounting firm. I didn't want to do accounting long term. I didn't really want to stay in that area, for too long, but I was told and it's played out that it's a great opportunity to kind of get in the business world, see, what you like, what you're good at. I ended up going down to Houston and, that's a big oil and gas city. It's the first time I've been there. But the one thing, I didn't know what kind of industry or what I wanted to do specifically. I just knew I wanted to see multiple things and, not kind of be a cog in a machine. So I did end up seeing some, oil and gas clients and going to, big factories and oil fields and seeing, all of these different types of valves and pipes and, machinery. And I had no idea what I was looking at. It was interesting, but I had no clue. 22-year-old kid versus, got on some real estate clients, commercial real estate clients. And, I can't tell you the difference between this valve and this gear and this oil, synthetic, but I can tell you the difference between a nice, retail strip center and a nice apartment building and one that's, having troubles or which one's better with real estate. It's, by living your life, it's, you don't have to have much technical knowledge to really start understanding, the real estate industry. So, that's kind of what led me down the path toward, real estate finance, and that it's very intuitive and so many people can grasp it, and you can kind of really, with no experience or with little experience, really kind of get a good understanding of the differences between assets. And say you want to jump into short-term rentals, it's easy and it's more accessible to me and to a lot of people because people stayed in Airbnbs, hotels. You don't have to have a degree in engineering to know what's a good Airbnb and what isn't. So that kind of set me on the path toward a career in real estate, and I haven't really looked back.
Yeah. I wonder if anyone's going to set up an Airbnb on an oil rig. That'll be a way of combining your first two answers. Probably not. Pretty confident that's not going to happen. Final question we have for you. Tell us something that you're listening to, watching, or reading these days.
Just kind of a jumble. But latest TV show I'm watching is called Echoes on Netflix. It's a little bit of an interesting, drama show. But in the middle of that, and that's the answer there. Very busy, obviously, building this company out, building this platform out. So not too much time for anything else. But that's a current interesting show I've been enjoying. Yeah, we know how it is. Spend the whole day working, evenings with our toddler, and then I fall asleep. That's kind of life. Awesome. Well, we'll link everything up in the show notes as to where people could find you and Easy Street Capital. But, what are some of the easiest ways to reach out to you, Robin? Yeah, it's easystreetcap.com. So that's just EASYSTREETCAP.com. And, we just relaunched our website, a couple months ago, and I think it looks really, really good. We do try to do a pretty good presence on social media. So I have, a pretty active, professional account on a few platforms, Twitter, Instagram. It's, Robin Simon ESC, so ROBIN SIMON ESC on both those platforms. But, it should be pretty easy to find on the website. on LinkedIn, on those platforms. And we're always open to talking to potential investors, mortgage brokers, real estate agents. We have a great referral program for real estate agents. And yeah, if you want to shoot me an email, it's just rvin@easystreetcap.com as well.
Great. Yeah. Website looks great. Really easy to navigate. Program terms are all there for all the loan products. I have it up on my screen right now. I'm sure that you tweak the page every so often as rates change, but it's all right here. So again, we'll link this up in the show notes. Rory, where can people find you?
You can come find me at my real estate brokerage, Next Home Titletown, nexthometitletown.com, or at my law practice, Urban Village Legal, urbanvillagelegal.com.
Awesome. And if you have questions about this discussion or this podcast, put them in the comment section. If you're watching this on YouTube, email me directly, jason@nexthometitletown.com. If you'd like to be a guest on the podcast, go ahead and do that as well. If you've enjoyed this and want to give us a rating, hopefully it's a 5-star rating, and we welcome those on iTunes or Spotify or anywhere else you can rate the podcast. Thank you for subscribing. Thank you for listening and learning about this. Robin, thank you for appearing on the Real Estate Law Podcast. This is a new world for people that have not navigated into this world. But for people that are, deep into scaling their portfolios, I think this is the only way you can go. And I really appreciate a lot of your insight into a lot of the loan products that you offer and the types of investors that you're working with. I think it's going to be super valuable for a lot of the people who are listening right now. That's my guess. So thanks, Robin. Thanks again for being on the podcast. And thank you for listening or watching. And we'll see you next time. Bye.
You found the Real Estate Law Podcast, because real estate is more than just pretty pictures, and law goes well beyond the paperwork and courtroom arguments. If you're a real estate professional or looking to build real estate expertise, then welcome to the conversation and discover more at realestatelawpodcast.com.